In this week's video, we'll review the latest charts and data to help us answer the question, is stock market momentum slowing in a 2008-like manner? It's a weekly chart of the S&P 500 with numerous weekly momentum indicators. Lower right-hand corner of your screen, you can see momentum is slowing a bit here, similar to this point here in 2023. There wasn't a lot of movement in the stock market the week of June 20th. The daily chart on your screen as of the close on June 20th, down 13 points. And for the week, we were basically flat, down 9 points. So not much has changed. And thus, it might be helpful to take a step back just to make sure we're not missing something on longer time frames relative to the daily chart. This is the S&P 500 index. This is calendar year 2000 here. It's a weekly chart. This is the type of look that we would want to avoid. This weekly chart starts with the 8-week moving average in blue all the way out to the 50-week moving average in gold. After the stock market peaked in March of 2000, you can see we transitioned from a full-bore bullish look to a full-bore bearish look, with blue the fastest moving average on the bottom of the stack, price below all the moving averages, and the slopes of all the moving averages have rolled over in this region here late in the year 2000. And between that peak in March of 2000 and the low in October of 2002, we really don't see any significant shift in the trend. Similar situation, financial crisis. This is Q4 of 2007. If you know your stock market history, the S&P 500 peaked in October of 2007, and once again, we morph into that full-bore bearish look. And we don't see meaningful improvement on that same weekly chart using the 8-week to the 50-week until after the major low in March of 2009. Thus, it might be helpful to know in the present day, in the context of slowing stock market momentum, how does June of 2025 compare to Q4 of 2007 and September of the year 2000? As you might expect, after a waterfall decline, the same weekly chart is improving, and we recently had the fastest moving average, the 8-week moving average, move back to the top of the stack. So much like the daily chart that we've been covering in recent weeks, as long as the S&P 500 can hold above 5750-ish here, it's relatively easy to remain patient. Since the markets were basically flat this week, we also want to try to gain an understanding relative to the weight of the evidence. Does it support the trying to remain patient approach? This is a weekly cloud chart of SPYG in the ETF world, S&P 500 growth stocks. The fact that SPYG has transitioned back to a full-bore bullish look on the weekly cloud tells us something about market participants and their expectations about future economic outcomes and expectations related to inflation, Fed policy, and corporate earnings. The upper right-hand corner of your screen really doesn't look anything like the bearish transition in January of 2022 here. The Nasdaq Composite has also seen significant improvement on its weekly cloud, and the same can be said for the Nasdaq 100 index, batting 1,000 relative to the boxes we would like to check on the weekly cloud. Is blue above red? Yes. Price above red? Yes. Price above the cloud? Yes. Has the cloud flipped from red to green? It has. Is the lagging span green above price? It is. If we jump out to a monthly time frame, the chart that we've been covering for some time now also leans bullish from a longer-term perspective. Compare and contrast the present day to this window in here, this window in here, and this window in here. Back to a daily time frame. This is the NYSE Composite, consolidating thus far in a healthy manner above the moving average stack. In this case, we're looking at the 50-day moving average in blue, all the way out to the 250-day moving average in silver. The markets, for the most part, were treading water this week, but not the semiconductor index, the SOX. It was up 1.94%. That, too, is a good sign economically. You can make an argument that we had a short stay, a bullish short stay look below the upward sloping 200-week moving average here near the major low in October of 2022, the major low in the S&P 500 a similar short stay look here, with price coming back and successfully testing this area here that previously acted as resistance. If the present day upper right hand corner of your screen morphed into something more like this or this, concerns would increase. And the slowing momentum as of June 20th has not caused any significant deterioration on the daily cloud of the S&P 500 index. And in terms of the 7 to 10 year outlook from market participants, really don't have anything that looks overly worrisome relative to a deflationary event or deflationary recession or a repeat of the 2022 inflation-induced bear market. IEF still in that same trading range that it's been in since calendar year 2022. Still seeing that long-term improvement in AIQ, Global Artificial Intelligence, and tech relative to SPY. The monthly cloud right-hand side of your screen has flipped from red to green. Not unusual for a cloud to act as support, so this looks like a bullish breakout or retest, and then we went on to print a higher high. Still has some work to do. When price and the spans are near the cloud, it tells us that we still have somewhat of an indecisive trend. I think you can make a rational argument that the present day is almost the polar opposite of this point here late in calendar year 2021, when ARKF made a significant lower low relative to this low here. We just made a significant higher high relative to this high here. You can see the moving average stack between the 20-day in blue all the way out to the 250-day in black is also trying to improve, with blue the fastest moving average on top and price above all of the moving averages. In terms of shifting our allocations, this chart would tell us that we want to be patient. We want to see what we want to see. We don't want to jump the gun. This is FTech, the Fidelity Information Technology Index, so a tech ETF relative to growth stocks, SPYG. And you can see tech has been underperforming for some time on the monthly cloud. From a price perspective, we'd like to see this ratio break this downward sloping trend line here. And we are still checking bearish boxes, several of them, on the monthly cloud. An improving look, yes, still some work to do. But if we compare the same ETF, FTech, the Fidelity Information Technology ETF, to SPY in a monthly time frame, this looks like healthy consolidation in here. We came back and we bounced at a flattish to now upward sloping 50-month moving average. And this looks like healthy consolidation on the right side of the screen relative to this region down here. This is the type of look that we want to see if we're looking for tech to reestablish a leadership position. This is IYW, iShares, U.S. technology relative to VU, the S&P 500 ETF from Vanguard. This is a weekly chart. We've now broken that downward sloping trend line. We're starting to move away from it. So if the slowing momentum in the S&P 500 results in this ratio backtracking, we would like to see it hold above this downward sloping trend line here. And all of this recent price action in here occurring above an upward sloping 200-week moving average in red. Another encouraging sign, SMH, semis relative to SPY, 2 weekly closes above this downward sloping trend line that dates back to the June-July time frame from calendar year 2024. Having said that, not a very confident look yet relative to the weekly closes on the high-low close bars. This is a so far so good chart. We'd like to see a little bit more conviction on this side. Still have a constructive look on that monthly cloud of SPYG growth relative to SPYV as in Victor value. This is one of the longer-term charts that helped us keep an open mind during the recent drawdown related to the tariffs. In another encouraging sign, XLK, the technology sector ETF, the tech sector for the S&P 500, making a new weekly closing high up here, up 0.57% for the week, closing above this level here, and this level here. longer above, the more relevant it would become. And all of that's happening in the context of a flattening out and now trying to turn up 20-week moving average in blue. Another constructive breakout look here. This is XLK Tech relative to RSP, the equal-weighted S&P 500 ETF. XLK outperformed RSP by 0.4% this week. This downward sloping trend line of XLK relative to SPYG dates all the way back to Q1 of 2024. You could make an argument this is a left shoulder in here, this is your head, and this is your right shoulder, and now we're above the neckline. It's also nice to see that we came back and undercut the 200-week moving average here, and now we've recaptured it. So far, so good. We'd like to see more. The media and the Fed, they keep telling us that the tariffs are going to cause inflation. The market's not buying it. Or at least the market's not thinking the Fed is going to have to raise interest rates. And if inflation were to take off, induced by the tariffs, well, then the Fed would have to raise interest rates. This is what it looks like over here, BSV, Vanguard Short-Term Bond ETF, when market participants are anticipating Fed rate hikes. This is what it looks like on June 20th, 2025. NASDAQ, new highs minus new lows. We still have a constructive turning back up look. Lower right-hand corner of your screen. Similar look here as the markets were bottoming in Q4 of 2023 after the 10% correction in the S&P 500 in Q4 of 2023. If you pause your video player here, we still have a constructive long-term setup in the NASDAQ Technical Index. Present day really doesn't look anything like late 2007, mid-year 2015, Q4 of 2018, or Q1 of 2022. And if the slowing momentum that we've seen in recent days, recent weeks, results in some backtracking, in terms of the anchored volume weighted average price chart for the S&P 500, I have several reference points going all the way back to 56.76. S&P 500 closed on June 20th at 59.67. It wouldn't be surprising if the slowing momentum resulted in a retest of this region down here. That also could make some sense in the context of the latest headlines. As market participants process new information, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind.
The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.